Dear friends, so far we have discussed the important terms, rules, and rate applicable for computation of depreciation under the different methods. So through this video, let us try to see another concept, that is additional depreciation. So this additional depreciation is eligible for plant and machinery if it is used for the production purpose. Section 32(1) clause 2a. So let us see what is that additional depreciation clause. On a new plant or machinery which has been acquired and installed by an assessee engaged in a business of manufacture or production of any article or thing, or in a business of generation, transmission, and distribution of power, additional depreciation shall be allowed at the rate of 20% in the first year of acquisition. Which means if an assessee has acquired and installed plant or machinery in his production unit, in the first year he is eligible to get an additional depreciation of 20% of the value of the asset. And if the asset which is put to use for less than 180 days, then he will get only 50% of that 20%, that is 10% additional depreciation. Here the remaining 10% he can claim in the next year, the next assessment year. Additional depreciation shall also be allowed if an assessee set up an undertaking or an enterprise for manufacture or produce an article or thing after 31st March 2015, he is eligible for additional depreciation. Similarly, it should be set up in notified backward area of the state of Andhra Pradesh or Bihar or in Telangana or in West Bengal, he is eligible. It should be acquired and installed any new machinery or plant other than ship and aircraft after 31st March 2015 but before 1st April 2020, the additional depreciation shall be allowed at the rate of 35%. If the plant and machinery put for use during the previous year for less than 180 days, then 17.5% of the depreciation shall be allowed. However, any machinery or plant which before its installation by the assessee was used either within or outside India by any other person, or any plant and machinery installed in any office or premises or any residential accommodation, including accommodation in the nature of guest house or any office appliances or road transport vehicle or any plant and machinery, the whole of the actual cost of which is allowed as deduction in computing the income chargeable under the head profits and gains of business or profession of any one previous year, the additional depreciation deduction shall not be allowed. Deduction of disallowed part of additional depreciation where new plant and machinery is acquired during the previous year and put to use for less than 180 days during the previous year. The additional depreciation is allowed at the rate of 50% of the prescribed rate, and the balance of 50% of additional depreciation shall be allowed in immediately succeeding previous year, which means the next assessment year he can claim that.
From the following figures, you are required to ascertain
the depreciation, admissible and other liabilities, if any, in respect of the previous year relevant to the assessment year 2020-21, and the particulars are written down value at the beginning of the year, additions during the year, and the sales during the year given for plant and machinery and building. And plant and machinery, it is 2,50,000, 3 lakh and 6 lakh, and building it is 10 lakh, nil and 2 lakh rupees. So let us try to work out this problem and let us see what will be the difference.
Computation of depreciation and capital gain. See, in this case, the first case it is plant and machinery. Plant is for 2,50,000 and addition was there for 3 lakh. So, beginning plant and machinery it is 2,50,000. Addition it is 3 lakh rupee. So the total plant and machinery is 5,50,000. But out of this, the complete is sold for rupees 6 lakh. The complete is sold for rupees 6 lakh, which means there is no balance, and it is a profit of 50,000, and this profit is said to be short term capital gain. So this is a short term capital gain. So in this case the depreciation need not be computed since the block of asset is not existing. The second case is building. The value of the building is 10 lakh and there was no addition, but sales was there, sold for 2 lakh. Therefore the written down value of this block of asset is 8 lakh. So we have to calculate the rate of depreciation based on this 8 lakh rupee. So let us assume that the rate of depreciation is 10% here, so that the depreciation to be charged here is 80,000, so that the written down value of this block of asset is 7,20,000. So this is the case for computation of depreciation and capital gain in the given case. Now let us assume that the asset is not sold. So the value of the block of asset is 5,50,000, which is eligible for depreciation. Assume that the depreciation percentage is 15. So that 15% of 5,50,000 can be claimed as depreciation. If this asset is used for the complete year, the full year, so that the depreciation is equal to 82,500 plus. If this machinery is used for production purpose, if it is a brand new machinery, the assessee is eligible to get an additional depreciation of 20% of 3 lakh rupee. It will be 60,000. Then the total depreciation is equal to 1,42,500. Therefore 1,42,500 will be the depreciation allowances, provided it included the additional depreciation and the normal depreciation. So here the provision of additional depreciation came. Another point is, suppose this asset put for use for less than 180 days, then he will be eligible to get, here it is 30,000, half of that 20%, and here also this full value will not get. Here the full value will get, but here for this value only half will be, he will be getting if it is put for use for less than 180 days. Hope this concept of enhanced depreciation or the additional depreciation is clear for you.
Kindly share it with your friends and others in the contact. If you have any comment, please leave it in the comment box. If you have suggestions, please make it there. If you have not subscribed my channel, please make it. Thank you very much for watching my channel.